Professionals point out that the most frequent errors in retirement planning are associated with timing factors like depleting one's savings prematurely or failing to grasp the long term effects of inflation on investments. What's the top error? Well, nearly half of financial planners agree that it's failing to recognize the significant influence inflation has on the purchasing power of retirement funds. In layman's terms, retirees underestimate inflation. That doesn't just set them back 10 or 20 grand, it can cause retirees to live in poverty for the rest of their lives. Hi, I'm Ivory Hecker for Noble Gold Investments. Let's go through the biggest mistakes retirees make when they plan for their retirement. In second place is people underestimating their lifespans. More than 46% of retirees make this mistake. The longer you live, the more retirement savings you'll need to replace your income. Add to that the healthcare costs associated with aging, which is another common retirement planning mistake, according to 39% of advisors. Most of the other top retirement mistakes revolve around investment planning, including overestimating investment income, 42%, investing too conservatively, 41%, and setting unrealistic return expectations, 40%. Given all these, what can you do? Well, number one, plan for retirement with inflation in mind. The destructive effects of inflation should not be underestimated. Even a slight increase compounds over the years, leading to a heavy burden in retirement. However, its actual impact depends on changes in expected inflation and age. In simple terms, younger people are affected more because they are further away from retirement age, which means high inflation erodes their purchasing power over a longer period. Manulife Investment Management sets up a useful calculation. Suppose there are three investors aged 25, 45, and 65 respectively, who all retire at age 65 and have the same annual expected expenses after retirement. They found that a 0.5% increase in expected inflation will result in a 21%, 13%, and 5% increase in retirement costs, respectively. If expected inflation increases to 1%, retirement costs will increase by 53%, 33%, and 13%, respectively. To live comfortably in retirement, all three individuals need to increase their savings to offset the effects of inflation. This affords them the ability to withdraw the predetermined amount of real inflation-adjusted income each year of their respective retirements. Number two, remember that government numbers on inflation are manipulated. Another factor to consider is how the government's current inflation numbers have been manipulated to make it appear lower. While the government claims the CPI is below 5% for several months now, the actual prices of goods say otherwise. Below are some grocery item price increases in the last 2 years. Meanwhile, even with the released government inflation numbers, food and housing costs rose by more than 8% over the same period in the last 12 months. It is always safer to double and triple the inflation number that the government provides. After all, this is your retirement we're talking about. Number three, calibrate your allocation. Regularly review your portfolio. Remember to revisit your portfolio regularly and consult a financial advisor. See what assets or industries you may be willing to try and what trends or possible events could affect the growth of your nest egg. For example, AI and cryptocurrencies are starting to boom. The growth has been fast, but it is also volatile. It may be worth considering, but only if you have the financial bandwidth to survive the volatility. The risky pile. Stocks have historically averaged annual returns well over average inflation. This fact makes owning stocks in your retirement portfolio one of the most effective tools available to protect your savings from sustained inflation. However, new asset classes like cryptocurrency may provide you with higher yields if you have the financial bandwidth to withstand its crashes. This is called the risky pile. These are assets that grow fast but are very volatile. Risky investments are ideal for people who already have the foundation of their portfolio down and have extra funds that they can gamble with. Maintain a hedge. We go through an economic downturn every 5.5 years on average. In each downturn, you need an asset that will retain its value while you wait for the others to recover. There are many different hedges, but the best one is gold. It has historically gone up each time we have an economic downturn. It has also outperformed the market and bonds. Keep an emergency fund. You need a cash cushion or emergency fund. While inflation will reduce the spending power of cash on hand over time, having cash available can cover unavoidable expenses at times when prices have risen. Remember that your retirement strategy will require adjustments along the way because of changes in inflation rates, market conditions, or your personal circumstances. If you use planning tools or work with a financial professional, carefully consider the right inflation estimates to use going forward. If you have not claimed Social Security benefits yet, remember that those benefits are adjusted for inflation, which could make waiting even more attractive. Noble Gold Investments is here to give you relevant and objective information that could help you make a decision when it comes to investing for your future. More importantly, they can cover all of your precious metals investment needs. They have associates waiting on the line to answer any questions you may have. You can start by going to their website, noblegoldinvestments.com. That's noblegoldinvestments.com.